What if I told you that a $3 trillion market wipeout isn't what it looks like on the surface? It's not just a bad day on Wall Street. The analysis we're going to break down here suggests it might be the first tremor from a much, much larger earthquake. Before we get into it, make sure to hit that subscribe button and support Geo9. It really helps us keep making these. All right, let's dive in.
So here's the puzzle, right? You've got companies like Nvidia just crushing it, posting these incredible record-breaking earnings. I mean, their CEO is on stage forecasting a massive next quarter. Everything seems fantastic. And then, bam, the market just melts down. What this really means is that investors, well, they're not worried about today. They're absolutely terrified about tomorrow.
And the scale of that terror is just staggering. We're talking about a market cap loss of nearly $3 trillion. And this happened in just a matter of hours. This is not some minor correction, folks. This is a shockwave that sent everyone scrambling for answers. And the analysis we're digging into today suggests that the answer, it's been hiding in plain sight this whole time.
So, what's the diagnosis? The core argument from this analysis is that we're not just in some strong market. No, we're in a massive, hyper-concentrated bubble. And it's all being fueled by the promise of AI. And like every bubble in history, it's defined by two things: its incredible size and its incredible fragility.
Okay, think about this for a second. The source uses a really powerful analogy. They call the AI boom a shell game. And it makes sense, right? You've got these immense amounts of money pouring into just a handful of companies. Not because they're making huge profits right now, but based on the promise that they will be someday down the line. The entire system is running on fumes, on the expectation of a future payoff that just hasn't shown up yet.
Now, this is where it gets really interesting because we can actually put numbers to this concentration. Get this, a staggering 80% of all stock market gains this year have come from these AI-related companies. And they're not just moving the market, they're driving at least 40% of all economic growth. So the crucial takeaway here is that the health of the entire economy is basically resting on the shoulders of just a few giant players.
And look, it's not just some fringe analyst shouting about this. We've got a quote here from Goldman Sachs, of all places, and it says it all. They say the stock market has already priced in the AI boom, that it's running way ahead of the actual economic impact. What does that mean in simple terms? It means we might have already hit the ceiling. The best-case scenario is already baked in.
And to put a hard number on that idea, let's talk about valuations. PE ratios, basically how much investors are willing to pay for $1 of earnings, are in the 90th percentile. Historically, that is an extreme level. I mean, the last time valuations were stretched this thin, it did not end well. This suggests there's basically zero room for error.
Okay, so if the bubble is stretched this thin, the big question is, what could pop it? Well, the analysis first points to internal pressures. Think of these as the cracks forming from the inside, the things that can make this whole structure really unstable.
And here's the twist. You'd think people would be getting cautious, right? Nope. The big tech hyperscalers, we're talking the giants, Amazon, Microsoft, Meta, they're doubling down hard. They are committed to spending over $320 billion in 2025 alone on things like data centers. They're just pouring money into this AI dream. But you have to ask, how long can you keep throwing billions at a promise before your shareholders start demanding an actual, real return?
Now, this next part is really easy to miss, but it changes everything. The analysis draws a direct and frankly pretty scary parallel to the dot-com bubble. And this isn't just a gut feeling, okay? There are specific financial metrics that are starting to look eerily similar.
Okay, so check this out. Back before the dot-com crash in 2000, two major red flags popped up. First, CapEx, that's capital expenditure, as a percentage of sales went above 13%. Second, CapEx to free cash flow went over 60%. Basically, this meant companies were spending almost all of their available cash just to expand, with almost nothing left in the bank.
Okay, so now think about this. Fast forward to today. The big AI players, their CapEx to sales ratio is already over 10%, and their CapEx to free cash flow is creeping right up to that same 60% danger zone. It's like history isn't just repeating, it's rhyming. They are playing this incredibly close to the edge. And hey, if this kind of perspective feels useful, take just a second to subscribe to Geo9. It genuinely helps us keep digging and bringing these stories to you.
And this right here, this might be the biggest internal weakness of all. It's the huge disconnect between Wall Street and Main Street. You've got Wall Street pumping billions into AI infrastructure and celebrating these record stock highs. Meanwhile, on Main Street, we're facing rising unemployment, up to 4.4%, and huge layoffs, like 153,000 in October alone. So the question becomes pretty obvious. If people are losing their jobs, who's going to buy all the stuff that's supposed to generate all this future AI revenue?
So, okay, we've got all these internal pressures building up. But what about the outside world? The analysis also points to external shocks. You know, the so-called black swans, the kind of things that can come out of nowhere and provide that final, fatal push.
And this analysis zeroes in on two major external risks that could seriously mess things up. First, a potential pullback of money from Japan, and second, the massive and rapidly growing competitive threat from China.
All right, so first up, why Japan? What's the deal there? Well, it turns out that Japanese investors are some of the biggest holders of U.S. stocks on the planet. But here's the thing, their own local market is getting stronger, and their bond yields are starting to surge. All of a sudden, pulling your money out of the U.S. and investing it back home looks a lot more attractive. If they start to do that in big numbers, you're literally pulling a massive pillar of support right out from under the U.S. market.
Okay, now let's talk about China, because this is genuinely stunning. Just forget the usual headlines for a second and look at the raw data on innovation. China's Tsinghua University, by itself, has produced roughly 800 AI patents. Now compare that to all of the US Ivy League universities combined. They're at about 100. That's an 8-to-1 advantage from a single Chinese university. Just let that sink in.
And it's not just patents. Behind those numbers is an absolutely enormous talent pipeline. This year alone, China is graduating 5 million students in STEM fields. The source calls it a literal army of talent that's ready to fuel the country's AI ambitions. 5 million.
So, the crucial point here is this. The threat from China isn't just that they're catching up, it's about their ability to innovate cheaper and faster, thanks to heavy government support and that gigantic talent pool we just talked about. I mean, think about it. If they can produce AI that's just as good, or even better, but at a fraction of the cost, what does that do to the sky-high valuations of American tech companies?
So, when you add it all up, all these internal pressures, all these external threats, the analysis naturally moves to the big, inevitable question. What happens next? Where do we go from here if these risks actually start to become reality?
Well, based on historical models, the analysis suggests something pretty sobering. A 20 to 30% market correction isn't some wild worst-case fantasy. It's actually a realistic possibility just to get valuations back down to their historical average. And that's before you even factor in the kind of panic that would almost certainly follow a drop like that.
So let's just recap the whole argument we've explored here. We've got clear signs of a highly concentrated, AI-driven bubble. That bubble is being weakened from the inside by insane levels of spending and a shaky consumer base. And at the same time, it's facing these huge external threats, especially a potential capital flight from Japan and intense competition from China.
And all of this brings us to the final, multi-trillion-dollar question. Is this time really different? Are we actually witnessing the birth of a revolutionary new economy that justifies all of this? Or is this just the latest, biggest, most fragile bubble yet, just waiting for that one black swan to come along and bring the whole thing crashing down? So how do you see it? I'd love to know. Drop your thoughts in the comments. And if you haven't subscribed yet, now's the time. Join us at Geo9 so you don't miss the next insight.